So our today's topic is external commercial borrowing. External commercial borrowing means commercial borrowing by an eligible Indian borrower from an eligible non-resident lender with an average maturity period of minimum years of 3 years with certain end use restrictions. So in recent times, ECB is gaining more prominence. Large corporates or even NBFCs, they are garnering more funds from ECBs. So what's there in it in ECBs, especially with reference to current economic scenarios? So let's begin. Let's dwell into this concept. In financial year 2025, Indian incorporated entities added a record $61 billion and NBFC led the way. As per the figures by RBI for the financial year 24-25, Indian entities registered 1379 ECBs totaling to $61.2 billion. So there is a process of the registration is there. So 1379 registrations were there and $61.2 billion were garnered by those corporates. Net inflow for foreign resources via ECBs grew 158% to $4.4 billion for initial 2 months of the current financial year 26, which were only $1.7 billion a year ago period. It means for the current financial year 2026, it is highly probable that this record of $61, $61.20, it will be breached. So what's there in it in the ECB? Why the large corporates or corporate houses they are chasing the external commercial borrowing when compared to the domestic credit market? Let's uh, dig up that particular aspect. For financial year 2025, total ECB filings reached 61.1 billion, which was 26% year on year, clocked a growth of that. Notably, non-banking NBFCs, they accounted for 43% of total inflows, significantly higher than the historical share of 20 to 37 over the previous 5 years. Now, what is the reason for this? That is the most important, the crucial point which we need to discuss. The reason is the first reason is the persistent interest rate differential between the domestic and international market has created a textbook case of arbitrage and rational corporate behavior. For example, JSW Steel it raised $900 million at just 180 BPS above the secured overnight financing rate, that is 4.4% currently SOFR. Means SOFR with some spirit, that is the interest rate which is being charged for the ECB borrowing by the non-resident lender. So there is a significant difference of that. If you see the 4.4% and if you add up 1.80% spread in it, so it will hardly come to 6.20%. That is the rate at which JSW, as per this article, it raised the fund. Whereas 1 year MCLR, that is the marginal cost of fund-based lending, is nearly it's 9%, or as on date, if you see, it is around 8.7 to 8.80%. So you see the difference between the domestic and international market when it comes to these types of lending. The advantage persists even after accounting for the hedging cost. So even though there may be hedging, you see the rupees depreciating, and these ECBs, if they are foreign currency denominated and rupees depreciating, then the currency risk is there. So even though you pay for this currency risk, means your hedging cost is there. Even in that case also, industry data indicates that fully hedged ECB still offer 20 to 30 bps cost advantage over the domestic borrowing options. So that is the most prominent and the most crucial reason, and the most logical reason, reasonable reason, that why this is happening. And second point is the RBI's liberalized ECB framework, which permit a firm to raise $750 million annually under the automatic route. This has made the things easier. So there are two routes. One is automatic route and the other one is approval route. So you need to take the approval if it is not under the automatic route. So under automatic route, a firm can raise $750 million. So in this case, say JSW still raised $900 million. So it might have taken the approval. It might have followed the approval route, but up to $750 million, the things are easier. But if we do the closer scrutiny of this particular aspect, we see that it reveals that much of the recent ECB activities has been directed toward the refinance rather than the new investment. Refinance means you have already borrowing in your balance sheet. You are a borrower. You already have loans here in your liability side, and when you replace this loan by availing another loan, that is called a refinancing. Means in the asset side it will remain intact. There is no such economic development as such or economic activity. You are simply replacing your existing loan with, say, with some additional, say, concession or additional margin, additional pricing. So that may be the additional benefit for while refinancing a loan. So the most of this ECB borrowing is directed toward the refinance. So according to RBI's State of Economic April Bulletin, Indian companies faced $25.8 billion in ECB principal repayment between April 25 to Feb 25. So firms like Mangalore Refinery and JSW Steel have used new offshore borrowing to refinance existing obligations, extend maturities, and manage rollover risk. Though financially prudent, refinance reflects a balance sheet strategy, not a growth impulse. Thus, the current ECB surge is easing the debt pressure for firm but is doing little to catalyze fresh investments in the economy. Mean for the economic perspective, for the growth perspective, it's not contributing too much. But from the liability side of a balance sheet, yes, there is a heavy reliance on those ECB borrowing, especially to repay, because in the domestic market, I think rates, they have not eased to the extent they should have. That is the major reason. The distortion in the financial interpretation process are evident when even large credit-worthy Indian corporations find it more rational to assume currency risk than to assess domestic capital. From a macroeconomic point of view, this is where the risk loom large. While the rupee has been stable of late, backed by RBI's robust foreign exchange reserve, that is $685 billion as on May 16, and around 880 tons of gold is there already. This claim is not guaranteed. India's geopolitical neighborhood remains volatile, and does global risk sentiment. If you see, you have foreign currency borrowing in the ECB is there, say that is dollar denominated, and if you say dollar is appreciating, say yield in the US, you know they are going up. So for a shorter or mid term, the dollar might appreciate as compared to rupee. So this, there is a risk of currency, because you as a borrower, you have borrowed, say you have borrowed $100 billion. So you may be paying, say, rupees 85 per dollar now, but with the depreciation you might pay rupees 87, because the rupee has depreciated. So that currency risk still looms, even though our forex reserves, even the RBI intervention may be there to strengthen the rupee, say in the form of foreign exchange reserves, or the gold storage is also there to support the rupee. But even though this risk cannot be obviated, that is the major risk, that currency risk is there. So that is the second point from the economic point of view, that this is the actual risk the economy may face. And if the entities are interconnected, it may turn into a financial stability risk also. And the first point was that it is not doing much for the economy. From the growth perspective, there is no growth, no economic investment stimulus, because it's mainly for the refinance activities. And the second point is the currency risk looms there. So what is the impact on economy if we recalibrate? Preference for offshore borrowing could slowly erode the depth of domestic capital market. That is the third point, because if you are borrowing more from the foreign, this non-resident lender, then what in it for the domestic market, for the domestic, not only the banking sector, but also for the capital or say debt market, because you are not getting the, you are not using the fund which is available with these institutions. So if large creditworthy corporates increasingly bypass Indian banks and bond market in favor of foreign capital, it leaves the domestic system to cater largely to subprime borrowers, because good borrowers, they are going they getting the ECBs, then the subprime borrowers, government and small business. So the margin, or say this financial repression may be there for the investors. So financial repression may also be there in such types of situation. So that needs to be understood from the economic perspective. Such an outcome is hardly a balanced one. It leaves the Indian financial intermediaries with less capacity to diversify the risk, making the economy more exposed to the external shock. So this is another major aspect. So 3 points we have discussed so far. The first point is there is hardly any impact on the investment. Second point is there is a currency risk, and third point is what about the domestic market. So these are the impact from the economy point of view. The what can be the impact on the economy because of the enhanced ECB borrowing. And from the large corporates or the corporates point of view, if you see, they are getting a benefit of say 30 to 40 bps cheaper rates, cheaper spreads they need to pay. Say even it may go up to 60 bps also. So depending on their credit worthiness, they are getting that much of benefit. So what need to be done is we need to see that this repo rate it has been cut by 100 bps since Feb. So that benefit should pass to the end borrower. That is the need of the time. So what is the ECB? We have discussed at the beginning of this video itself, that is defined as the commercial loan in the form of the bank loan, buyer's credit, supplier's credit, known as trade credit, and securities instruments available from non-lenders with minimum average maturity period of 3 years. So what are the other points? They are very important points. Let's dwell into that. The minimum average maturity period of all ECBs has been prescribed as 3 years. That is the minimum tenure of an ECB, except those raised from foreign equity holders and utilized for working capital purpose, general corporate purpose, or repayment of rupee term loan, where it will be 5 years. A special dispensation to the manufacturing sector has been given for raising up to $50 million with a maturity period of 1 year. So this table will be suffice to say what will the minimum average maturity MAMP, minimum average maturity period. So 1 year in case of a manufacturing company who raising up to $50 billion. So 1 year is there. That is the minimum tenure. Then or sorry, maturity period, minimum average maturity period. Then for the foreign equity holders for working capital purpose, general corporate purpose, it will be 5 years. When ECB is raised for working capital purpose or general corporate purpose, or on lending by NBFCs for the same purpose, then it's 10 years. ECB raised for repayment of rupee term loan availed domestically for capex is 7 years, or the NBFC for the same purpose. When ECB is raised for repayment of the rupee term loan other than the capex, then it's 10 years, and on lending by NBFC for the same purpose. What is the limit of ECB's? Sector specific limit that have been done away. As of now, ECB up to $750 million per financial year can be raised under the automatic route. In case of foreign currency denominated ECB is raised under the automatic route, the borrower ECB liability equity ratio cannot exceed 7:1. A very important point. The 7:1 is the ratio. If the outstanding loan amount of all ECB including proposed one exceed $5 million, then it will not be applicable. Then other point is what is the form of ECB? The bank loans is in the form of the bank loan or the other loan. Then you have securitized instruments like floating rate notes, fixed rate bonds, non-convertible, partially convertible or optionally convertible preferential or bonds or debenture. Then trade credit beyond 3 years. These are typically categorized as a buyer's credit or supplier's credit. Or then you have foreign currency convertible bonds, means they will be converted into the equity of the issuing company. That's how they are different to foreign currency exchangeable bond. In the exchangeable bond, they are converted to the equity of the another company, usually a subsidiary of the borrowing company. So that's how they are different. Then financial lease means this involves a leasing company who purchase the asset and then lease it to the borrower, then transferring the risk and reward of ownership. So that is also a type of borrowing only. Then Indian national rupee denominated, it is like masala bonds are there. Masala bonds, they are rupee denominated external borrowings. So in the rupee denominated borrowing, what is the important point here to note? That there is no currency risk because they are rupee denominated. Even rupee moves up or moves down, if rupee moves up, it's good for them. Okay, no, sorry, if rupee moves up or move down, it will not impact any financial liability or any gain to the borrower. They will remain neutral in both the situation. So that's how it's rupee denominated bond. Then recognized lender under the ECB is the resident of FATF or IOSCO compliant countries. FATF Financial Action Task Force. They should not be country identified in the public statement of FATF as a jurisdiction having strategic AML or CFT combating financial terrorism deficiencies, or a jurisdiction that has not made sufficient progress in addressing those deficiencies. Then IOSCO compliant companies like International Organization of Securities Commissions, multilateral memorandum of understanding, or signatory to the bilateral memorandum of understanding with the SEBI or for information sharing arrangement. Then multilateral institutions, they are also recognized like IFC, ADB, IMF. Then all these institutions, they are eligible lenders. Eligible borrower with an Indian borrower who can garner it in the foreign currency FCY denominated ECBs, like who are eligible to receive the FDI, they can do it. Then port and trust are there, unit in SCZ, CDB, Exim Bank, they are there. Then INR, Indian National Rupee denominated, like those who are eligible to raise ECB, they are also eligible to this. Then engaged in microfinancing activities, NGOs, NPOs, then registered societies and cooperatives, they can also garner ECB is very important point. Then all in cost ceiling is there. What is the ceiling is that what are the component of ECB? If you see the cost, then the cost will comprise of rate of interest, there are other expense, then you have guarantee fees, export credit agency charges may be there, whether paid in foreign currency or INR, they will be counted. But it will exclude the commitment fees or withholding tax payable in Indian XLP. Then if the issue expenses are there, then they should not exceed 4% for the issue size for private placement and 2% in case of other issue size. Then that ceiling is there, it should not breach. Then component of trade credit will remain this rate of interest, this guarantee fees and other charges, and withholding tax shall not be part of all in cost. uh, if you come to other costs like prepayment charges, penal interest, it should not be more than 2% over and above the contracted rate, and it will be outside the all in cost ceiling. So these 4% like issue charges or prepayment, they are there, this ceiling has been there, but they are not part of this all in cost ceiling. But what actually is all in cost ceiling is from December 21, this benchmark rate plus 500 bps. It should not be more than that. That is the pricing rate of interest of the external commercial borrowing. This issuer or the lender should not charge more than that. The lender should not charge more than that. When it comes to INR denominated, then it should be 450. Should be the spread over the benchmark rate. Now, what is the benchmark rate? So benchmark rate generally it's a alternative reference rate which we call ARR of 6 months tenure. That will be the benchmark rate. Whereas in Indian National Rupee denominated ECBs, then it will the benchmark will be GSEC yield of the corresponding maturity. Say it's a 3-year bond, so the par yield of 3-year GSEC will be seen. If it 10 years, then 10 years GSEC that will be checked. Then up on that yield, the spread of maximum spread of 450 can be applied. Say as of now at the 10 years let's say for example 6.38%, then 4.5 you can apply on over and above it, then the rate will be like 10.8. This should be the maximum rate of or the pricing which can be there for the rupee denominated external commercial borrowing. I hope the point is clear. Now what is the end use restrictions? The most important point. The end use restriction is that it should not be used for real estate activities involving in the own or lease properties for buying, selling, and renting of commercial and residential properties. So real estate, commercial real estate, they are not allowed to raise this. But this will exclude construction and development of industrial park or SEZ, purchasing or long-term leasing of industrial land as a part of new project model and expansion of existing. So it should be the industrial land and activities under the infrastructure sector definition, like that is you should refer the harmonized master list that is there for the infrastructure. 37 subsectors are there. So if it is under the infrastructure, then it will be allowed. Then investment in capital market or equity investment, the cannot be used. Workable purpose, general corporate purpose, except for the purpose from the foreign. What does it mean? Means say you have taken a loan for a particular purpose, but at the end of it you are using it for this, then not allowed. If you are availing the fund for this particular purpose, then only you can do it. Same way, you are availing a purpose for the loan for the purpose of working capital, but you are using it for the repayment of rupee term loan, then you cannot do it. You should take the fund for this particular purpose. Rupee is fungible, you know it, but we need to ensure that there is an end use. That's why the end use makes sense. If you see the rupee as fungible item, then how will you justify the end use? The end use should be there. So end use should be there, means the fund should be utilized for the purpose for which it was availed. It cannot be substituted with some other purposes. So if it has been asked for repayment of term loan, it should be utilized for that. And for on lending for aforesaid purposes, then NBFCs, means if the NBFC is there, you can utilize it for the purpose for which it is required, except the real estate or the investment in equity and all this. So hope this lecture, that is, it is very important to know about the pricing, external commercial borrowing, its impact on the corporations and economy as a whole. Thank you.